Hello, I'm your host, Effie Pilarinu, and today we are going to be talking about new recipes in finance. I have the pleasure of having a guest that is not a new guest to my channel, Arun Krishna Kumar. Welcome, Arun.
Thanks for having me, Effie. I look forward to the discussion.
Yeah, and this time again, in my mind, it's really new recipes, new cooking, because I think the truth is that the blockchain world is really a world that is disrupting in the genuine sense financial services. That has been true whether we are in a hype phase. Now we are not probably in that hype phase of 2017, but it's all about different ways of manufacturing financial services versus just different ways of delivering at the customer experience level. So that's how I like to think of this. And today we want to talk about staking, and that is really a new recipe. And it's interesting also. This month, September, is just 2 years since Ethereum moved to proof of stake. I remember wondering how I could stake my Ether. At the time, I didn't have enough Ether, the 32 Ether that was required. And then, after that, there were services where you could give your Ether, whether it was 1, 2, 10, as many as you had, and they could stake. And staking is something that has caught on, and I think that financial services, traditional people, probably they understand it as comparable to deposits. What do you think, Arun?
That's pretty much the explanation I gave to my mom when I joined Marinade. So she basically asked, "What do you do?" And I said, "I do pretty much what dad did as a banker." Because he would be assigned a particular village or a town to be a banker in, and he would make friends with all the businessmen, local businessmen there. And when they needed a loan, he would be able to give them a loan. And when they had cash, they would deposit in his bank, and his targets would be deposits for the year. And that's very similar to what I'm doing as well at Marinade, which is spending a lot of time with my hedge funds, VC funds, and ETFs in London, and seeing which one of them have a lot of Solana, and hoping that they will be able to use Marinade for their staking needs, and so that we'll be able to give them the rewards that the chain is able to produce as part of the inflation. So that's really what I do, and that's the new journey really.
Yeah, but staking has sort of evolved, and there's so many types of staking. I'm aware of restaking, of liquid staking, and it's getting quite complicated. And this is not, I think, similar to, a current deposit and a savings deposit and so on. It's much more complicated. And can you help us understand these differences in terms of what are they, what's the reward, and what's the risk?
Absolutely. So I think as you started this discussion with Ethereum as an example, I think that is where proof of stake really had a massive boost, I would say. And even before then, there were other chains who had started going down the line of the proof of stake mechanism. It is just a new consensus mechanism that a majority of the crypto world have adopted post proof of work. Bitcoin started as a proof of work engine, and then we had some pushback to see that it could be environmentally a challenge. It may not be ESG friendly. So I think that was probably, in my opinion, a big reason why a larger part of the blockchain world moved towards proof of stake. So how does this work? The holders of the token of the chain, if you're on the Ethereum chain, you hold ETH. If you're on the Solana chain, you hold Sol, and they stake, which is basically deposit their tokens onto the network. And that is used to secure the network and also enable transactions execution. on the network. And you do it through, at least on Solana, you do the, just like banks in a economy, you have validators within the blockchain world to whom you delegate or to whom you stake your tokens. And what happens is, because you're helping the chain to decentralize itself and to be secure through your staking mechanism, the chain kind of rewards you, and that becomes your inflation rewards. So that is really what staking works. Now, when you directly stake to the chain, that is called native staking. So that was the first incarnation of staking. That's how staking started. But then when staking started on Ethereum, one of the biggest challenge was that there were liquidity risks, which is, if you stake to Ethereum at that point, you didn't even know when you'll be able to unstake your Ethereum. The unstake really happened as part of a more recent upgrade. I think it was early last year or something like that, or early this year. So I'm losing track of time. Apologies for that. But sorry, go ahead. If you have to say
No,
something.
no, it's fine. Yeah.
Okay, so the unstake process really wasn't very clear with Ethereum. Even today, if you stake and unstake, it takes several days for your stake to come back to
It's
you.
a bit
Several-
similar to cold storage. So the process is that you have to wait a couple of days until you get access.
which with Ethereum, I think it is 3 weeks or something, if I'm right. It's 18 days is what I mean. Back in 21, 22, probably 22, and even some part of 23, I don't think you even knew when you will get your Ethereum back.
Yeah, yeah.
Whereas with Solana, and I'm not saying one is a better chain than the other, it is just because Solana came after Ethereum. So
Yeah.
they could sit on the shoulders of Ethereum and design a few things in a slightly better way. But with Solana, when you stake and unstake, you get your Solana back very soon or within 2 days at the most. So
My
that's the difference.
personal experience, now that you say that, with Ether is 10 days right now.
Maybe.
I don't know
Yeah.
if it's a rule or, it depends on the provider or so on, but it was 10 days the last time I tried to unstake.
Sure. And with some of the L2s, I think I have tried staking on Ethereum, Polygon, and Solana. Those are the three chains I've used for from a staking perspective as a user. And I've had to wait sometimes 3 weeks on Polygon for sure. I remember that. So they all have different SLAs when you get your stake back. But the reason why native staking led to something called liquid staking was because of a lack of liquidity if you staked all your Ethereum to the chain, which means you won't have any Ethereum in your wallet left for you to be able to do DeFi work. So you can't lend on a DeFi platform.
Yeah.
And if you're a crypto native, you realize that that's a very important thing. And even today, there are lots of funds that use liquid staked assets as collateral for their fund. So there are a couple of TradFi use cases why liquid staking is relevant. But the reason liquid staking really came about back in 2021, 22 was because ETH as a chain, when you stake, it resulted in a liquidity challenge. So what liquid staking does is, it is a variant of native staking. And as soon as you stake, you get an equivalent amount of ETH back in your wallet, which you can then use for DeFi activities. And Lido, as a top name within Ethereum, they kind of are, and I mean, were, and today they are still the industry leaders on Ethereum who led the liquid staking market on Ethereum.
Yeah. And just to go back to staking, native staking, what are the risks there in terms of, is there a risk of losing one's Ether or Solana or whatever we are staking, and where is that risk?
Absolutely. And the risk profiles are slightly different depending on the chain as well. So with Ethereum, let me start with Ethereum. With Ethereum, when you stake, the Ethereum tokens leave your wallet. So it goes to a validator, right? It goes to the chain. And because it leaves your wallet, there is a genuine counterparty risk.
Okay.
Right? So that is the first thing. And on Ethereum, if the validator goes down, has a downtime, the Ethereum gets slashed because the validator is basically saying, hey, I will validate transactions, but you've not done that for 2, 3, 4, 5 days continuously, there's a penalty for that. So because there is slashing, your principal is at risk. And of course, your rewards for that period of time is also at risk.
Yeah.
So those are the three risks with it. With Solana, the way they have constructed it is, again, I don't intend to make Solana look like a better chain, but I'm just explaining the mechanics in a very objective way. Your tokens don't leave your chain.
Your wallet.
So, sorry, your wallet, sorry. You
Yeah.
still hold custody of your Solana even when you stake. You can actually go and see your Solana in your wallet. If you're staking it through a phantom
Yeah.
wallet, you'll be able to see Solana sitting inside your wallet after staking it. And slashing hasn't been introduced on Solana yet. So if the validator goes down for a day or two, you will lose your rewards, but you won't lose your principal.
Principal. Okay.
Right?
Okay.
So there is lesser counterparty risk, or actually no counterparty risk on staking with Solana. And there is lower principal risk. Your principal is safe. And rewards, of course, is, I think the risks are the same across these two chains. These are the general risk parameters while you're staking between Ethereum and Solana.
Okay. Okay. So can I think of liquid staking as a derivative?
Okay, that's actually a word that I got told off from using. I was talking to a legal team. I'm not going to mention the organization. It wasn't Marinade, by the way. We were writing up something to explain liquid staking, and I had LSD, basically, liquid staking derivatives, as my first TLA. And they came back saying no more usage of derivatives. We call it LSTs now, liquid staking tokens now. So I think the whole world is now getting compliance ready. You can't use words like yields. You can't use words like returns.
Okay.
It's always rewards.
Because of legal and compliance. Okay.
Legal and compliance reasons. Now, in terms of T, the way it is structured exposes the staker to a bunch of risks. So LST has smart contracts, user smart contracts. So when you stake to an LST, if you and I staked our Ethereum on Lido, both our Ethereum goes to the same smart contract.
Okay.
Right? So you're exposing yourself to smart contract hacks, right? So there's a hacker. That's a smart contract risk has been one of the biggest risks in crypto.
Yeah.
So that cyber risk is there. The second one is if you're running an ETF and you moving your client's SOL or ETH into a smart contract, sitting with all their clients' money in one smart contract, and alongside other ETFs assets as well, that's co-mingling of funds.
Commingling. Yeah. 100%.
So that is the challenge. That's a bigger regulatory risk if you use LSD.
Okay.
So one of the things that there have been some variants of LSTs that firms like, for instance, Alluvial have actually implemented. I haven't actually double clicked into the exact model, but what I'm hearing is they offer client money segregation even through a smart contract model. I'm not technically proficient enough
can
to kind
imagine,
of
yeah, that much like what I'm hearing from you is that, for example, Solana has improved on some of the challenges that existed on the Ethereum blockchain, and now others will come in and try to improve on different aspects that we've realized are problems on the Solana network or other networks, and that's how the market is evolving, right? Because
absolutely. I mean, I that's how I'm grateful that the market is thinking about this as well, because 5 years back, someone building staking even on Ethereum or Solana wouldn't be thinking about regulatory risks. Now there are firms thinking about regulatory risk because we know, thanks to the ETFs, there's going to be huge flows coming through ETFs over the course of the next 4, 5, 10 years. And these staking products will be a way where these big bag holders will be looking to earn some rewards. And there is no way they'll be able to put their assets into a smart contract if they are being regulated. There are products, I think, more on Ethereum, and I haven't seen a LST-based regulatory friendly product on Solana yet. Solana is generally a year or so behind Ethereum, so I'm sure someone is thinking about it. But that is something that would be very interesting to see, because if you can offer the liquidity that LSTs are able to provide while being regulatory friendly, you will still have smart contract risk, by the way. So the smart contract risk is not going to go away, but the regulatory risk can come down if you have client money segregation
Well,
possible on it.
If the smart contract, there wasn't just one smart contract that's commingling all the funds, then you're diversifying. If you had as many smart contracts holding the funds of the different users, then already you're lowering the risk, because
Exactly.
it's decentralized or distributed, if you want. Like,
Precisely.
Arun, let's go into the institutional world, because I mean, it's clear that there is an interest to offer staking, through institutional products. But is that happening? I mean, I know here in Switzerland, where we've had a long tradition, and for a while we've had institutional crypto products that are listed on the exchange, and I think that we have now 2 products that are with staking. I was looking at them a while ago, and I couldn't understand why they're not doing better than the plain vanilla ones. And I did get some answers from the issuers, but I would have thought that they should have been doing much better in performance. But what is going on there? What do you understand from the institutional world, be it hedge funds, be it ETF issuers, or active managed certificates, AMCs that have crypto?
Sure. So on the ETF side, Switzerland and generally Europe, but Switzerland primarily and UK are definitely ahead of North America when it comes to ETFs and that part of the world. And
ETF.
apart from that, the only other meaningful, sizable institutional bag holders are the VCs. So VCs who invested in some of these blockchains quite early on have quite a bunch that they can stake. But thinking about traditional regulated institutions, that would be ETF issuers at the moment that are looking to stake. Now that model, most of the ETFs take 21 shares or Valor or ETC Group in the UK, or there is number of these names that are based in Europe and operate in this part of the world. They started on as for initially as BTC ETFs. They then launched their ETH ETFs without staking, and then more recently, many of them have launched a ETH staking ETF. What I understand from them is, in conversations with them, is there are challenges in actually just converting an existing non-staked ETH ETF to a staked ETH ETF. So what they prefer to do for reduce legal complication is let's just start a staking ETF. So that's the way they have gone about most of these ETFs. So one of the things it's important to understand is that these ETFs and these institutions are not going to go to a decentralized application, connect their wallet, and say stake. They will need institutional guardrails, and that's where many of these custodians come into picture. So Coinbase, BitGo, Anchorage, we have Zodia in the UK, we have Komainu, we have Copper. A lot of these institutional wallet providers and custody providers,
Custody providers, basically.
custody providers, exactly. They provide these crypto wallets with institutional insurance and all these different compliance controls. And that is where these ETFs feel very comfortable working through.
Okay.
And for DeFi firms to really offer their services to these ETFs, they should be first working with these custodians.
Okay.
And
That is where the excess returns are lost. I guess we need more intermediaries. And I mean, is staking on Ether, unless it's high rewards, you're not going to see.
I think the custody fees are not as high. Actually, it's I think 20 bips or something like that, if I understand it right. So they still should make meaningful returns if they stake through custodians. But particularly on Ethereum, the challenge is this, Efi, with a lot of these staked ETF models is liquidity risks, right? So even when you stake, let's take it's public information, so I'm going to share this with you. Let's take 21 shares, for instance. 21 shares run a Solana ETF, and they basically have about 7 million SOL under management. And of the 7 million SOL, they are only able to stake 4 million or something like that, because they need to keep about 40% of their fund
Yes.
ready for redemptions.
Yes.
Right? If there's a market crisis and there is a huge redemption event, they will need to be able to address that. So they keep 3 million SOL unstaked, which is why the gross rewards that they're able to offer on
Ah.
their 7 million is
Mhm.
like 3.5 to 4% when the chain is offering them 6.5 to 7%.
Okay, got
So
you.
that is the challenge with ETFs. They are always going to be probably somewhere around the 60% mark of what an investor or an individual can just get out of the DApp, the application, if they went and did it directly there.
Yeah, yeah. So basically, the institutional players are not going to the DeFi applications directly. They have to go through these regulated entities, and it's a different kind of, yeah, I understand what the risk return may be even better, but because they're taking less risk, obviously the return is less, and that's the reality of it.
And some of these ETFs are very comfortable the moment you have your integration with these custodians,
Okay.
because the process of just getting your product integrated with the custodian means you've gone through the regulatory rigor. And this is now public information, so I can share this with you as well. So we just announced, as Marinade, we just announced integration with Copper and Zodia last week. So
Okay.
we went live with Copper. Zodia is probably 3 weeks away, but the announcements are out there because it's all nearly there. It's been 6 months effort just to work with them, get the product teams talking to each other, getting the legal work out of the way. So there's a lot of compliance related work in the process. We also went work with the FCA, answered a lot of their questions, going back and forth, making sure that the FCA were comfortable. And as of last week, the FCA have said we are comfortable with the product as well. So that is the level of due diligence that DeFi apps will have to be open to if they really want institutional flows into their application.
And from the validator's perspective, that's a whole network, and I kind of understand how that works in the native DeFi world. Anybody could be a validator in theory. What is happening in the institutional world? Do we have institutional validators? How is that network? Problems, decentralization, or concentration?
We could have a separate episode just talking about the validators. There is so much fun actually studying the validator and understanding that landscape. But I'll give you a little bit of the
Yeah.
landscape there. So you're right. From an institutional perspective, there are quite a lot of organizations like Chorus One, Figment, Kiln, Block Demon. All these firms run their own validators. And in their case, they run it with institutional controls, which is have insurance in place and report on their uptimes and all that to their stakers, who are generally institutions. And oftentimes, a lot of these validator providers like Figment, they just don't run validators for one chain. They run it across multiple different chains. So
Okay.
if you're an ETF and if you're using Figment's validator for Ethereum, you would also benefit by running or using Figment's validators for Solana as well, because often there is like cross-pollination of
Yeah.
rewards and stuff like that. So the commercial handshake feels better when you're sticking to one single provider. The challenge in going with a single validator model, even though they have institutional controls, is that they're a centralization risk, they add counterparty risk,
Yeah.
right? So centralization risk is more for the network. So for instance, Coinbase have one of the largest Solana validators. I think they have about 7 or 8 million SOL staked with them. That's a huge centralization risk for the chain. And in similar way, if a Figment's validator goes down, and actually it happened with Coinbase as well, for literally a few hours, and the stakers have lost their rewards, right? And that's on Solana. If it happens on Ethereum, there is slashing risk as well. Of course, they come with insurance and all that packaged in so that they'll be able to mitigate these risks to some extent. But in crisis times,
No.
these insurance don't help. So that is the challenge with some of these setups. However, that is a key market that the institutions are currently working with. They're very comfortable working with these very institutionalized validator networks or validator organizations. On the other hand, there are public validators which take retail Sol or ETH and provide consensus to the or validator support to the chain. And there it is a lot more a lot more interesting because you see a lot of different flavors. And if you, I mean, again, just double click into the Solana validator ecosystem, it's become such a competitive landscape, and in some sense the validator business is almost a race to zero, is what a lot of people feel. Because
Commoditized completely.
sorry, come again.
It's commoditized completely. The margins
Exactly, it is.
are going to zero.
Exactly. And there are lots of different ways they can scale. So if you and I want to start a validator business on Solana today, there are ways to bootstrap ourselves to 100K Sol, maybe 200K Sol even. There are number of staking pools, including Marinade. There are 3 other staking pools. And if you work with us and if you're able to meet our thresholds in both commercial and time standards, then yes, you will be able to get some stake from us. But on top of that, the Solana Foundation also helps drive new validator inclusion into the network because it drives decentralization for them. However, to be able to get all that, there are huge, what do you call it, hurdles to go through. And by the time someone is able to get to 200K Sol, they are already down by a lot of money, both on the infrastructure side, but also other costs that goes into acquiring this stake. So in some sense, it is going to be a challenge for the open validator ecosystem, not just on Solana, across the more mature chains. Probably what could save them is an appreciation of price of the token, but you cannot really rely on that to run a viable model, right? So
So there's
it is.
is there probably going to be consolidation like we would expect in the traditional world when, competition pushes everything margins to zero, then you have consolidation or,
I think we probably see the very similar thing to Bitcoin miners, right? Because after halving, there is often a selling pressure. There's often a period when Bitcoin goes through a sell pressure period where miners are selling the Bitcoin to sustain themselves.
Yeah.
And only after the price of Bitcoin probably gets to a point where they actually can't sustain the pressure from there, does it starts going up, and thanks to the supply being halved. So I think we'll start seeing some of those mechanics actually start coming up with the other proof of stake chains as well. The other interesting thing that I see is validator businesses that are actually looking at multiple chains start with the younger chains first because it's easier to get in. It's generally lower cost in terms of infrastructure asks, and also it's also easier to build your base of token that you need to run the validator. And once you start making some money there, then you move to a slightly more mature chain. That's what I see. I mean, I was at ETHCC in July, and I met with a guy who explained to me how this whole thing works, how he's managed to build his business. And he was just going to join Solana and running a Solana validator, and he was asking me for advice there. But the point I'm understanding is you don't start with the more mature chains. If you're looking to run a validator business, you start with the younger chains.
younger
The
things where
Lunas, the Berat
there's a
chain.
bit of fat there to get. Arun, as I hear you speaking about the institutional validators, I'm wondering, being here in Switzerland, whether the crypto licensed banks here and the established brokers, Bitcoin Swiss or Amina Bank and so on, are they running validators? They are, right?
So Amina Bank have just launched a validator business. they are one of our sponsors of Stake Point, the event that we are running in Singapore this week. And they want to showcase their business from a validator perspective. I think there are some regulatory controls in terms of how much they can sell their validator business in some sense. I think I have to be careful about on the marketing side. They have to be careful about the marketing aspect of it. But yes, so Amina Bank are doing it. I am also hearing a few ETFs are planning to launch their own validators as well. It
Okay.
just makes sense, right? So you're anyways going to hold a million SOL, for instance, or 50,000 ETH in your ETF. You should just run your own validator, because validators, if you have the
Yeah.
token mined, it's a
Yeah.
profitable business,
Yeah.
right? So
Understood.
like,
Understood.
very
Understood.
profitable business.
Yeah, yeah, yeah. So I imagine there's other players here in Switzerland. I won't go down the names that have, they're in that business, which it really means that, you start from a laser focused niche, whether, it's brokerage, asset management, whatever it is, custody, and then you grow through the ecosystem, what you're involved in and what services you offer. Arun, this was a wonderful conversation. Before we close, what are you excited about in the staking world?
I'm pretty bullish on the institutional involvement in this space. I think one of the things that I'm noticing when you and I, we know we've been in this space for like at least two previous cycles. We've
Yeah.
2017, 2018, then 2021 as well. This feels a lot more different, I feel, this time. Because thanks to the ETFs, thanks to the work that BlackRock is doing as the marketing agency of crypto these days.
The CMO of Bitcoin and of the blockchain space, right? The thing.
Absolutely, absolutely. I think a lot. I'm talking to so many institutions on a daily basis, and the amount of interest, of course, within regulatory rigor and within regulatory rails, the amount of interest and openness I'm seeing, not just from the TradFi firms, custody providers, ETFs, but also from the regulators. They're very open to talking to you, at least in Europe. And I wouldn't say the same thing about the US regulators, but at least in Europe, you're seeing a lot of collaborative conversations happening. And I mean, as we all know, I mean, the space is getting so big that it is not just, I mean, there used to be a time when you could stay on top of everything happening on Ethereum. And I used to think I can stay on top of everything happening on Solana. But now I'm struggling to keep on top of everything happening within Solana staking. So that is the amount of activity you're seeing in this space. So I'm pretty excited and bullish for not just staking, in generally the area where there is an overlap between DeFi and TradFi. I think that I'm very bullish, be it RWAs, be it staking, the ETFs, all these different things come with different flavors, challenges to solve. And I feel like we're just building the next version of capital markets. And I feel very privileged to be part of this ecosystem.
Great, great, Arun. And before we close on a personal note, what are you reading? What are you listening? Is there any podcast that you're excited about? A book that you're reading? What people that you're following and are inspiring you, or maybe contrarians?
Oh, wow. Okay. So at this point, the biggest thing that I'm academically studying is the validator landscape. And I mean, this is not just a Solana problem. It is a problem across all the chains out there where there are illicit activities like sandwiching that's happening. And I'm just studying what are the solutions? I know people have been in this space for 5 years and given up on solving this, but it generally requires a huge ecosystem to come together and see how that can be addressed
What
so
is
that
sandwiching? What is sandwiching?
so sandwiching is a method in which a validator basically, so let's say hypothetically you are basically putting in a buying 100,000 Solana. You've basically you've gone to a decentralized exchange and say, hey, I want to buy 100,000 Solana. And that transaction is coming through, the validator notices the transaction, and they know that just after the transaction or by virtue of the transaction, the price of Solana is going to go up on that DEX. So what they do is they sandwich it with one of their transactions, which is a buy transaction before and a sell transaction after. And what they do is they typically do it where you set the slippage of your transaction to high, because you're probably desperate to buy some meme coins at a particular particular price and you set your slippage to a higher number. So what they do is they make sure you lose the entire slippage by sandwiching this transaction.
That's a
So
bit
this is
like old-fashioned front running in a way.
yeah, front running, pretty much front running. It's not any different. But there are several patterns to this, and it's very hard for a normal bot or a program to track this down and proactively keep hunting down these validators. And also, it's blockchain world is not open to censorship either. So there are in principle challenges in terms of how do we go about addressing this, but there is also commercial challenges around it, which and these activities are making some businesses unviable as well. So there are like a it's a huge problem that the entire blockchain ecosystem needs to address. That is what I'm reading a lot about, talking to people, researching what can be done here. So apart from that, I'm not sure I've read any major books. Apart the most recent amazing book that I read was Leda's book.
Like us, yes.
Yeah,
Or,
bankers like us. So that I still have it just behind me. So
yeah.
that was an amazing book. Apart from that, I've not really read much in recent times.
Yeah, I guess the world that keeps you busy, and as you said, there's so much going on in the space that even keeping up to that is a
Absolutely.
challenge. Well, thank you again, Arun.
Thank you so much for having me, Effie.